Today we cover part 2 of chapter 10, which covers substantive testing of revenues and the accounts receivable process. I thought you guys might like to see that our teaching assistant has joined us for today's lecture. So this slide is just to remind you that we spent all that time in part 1 talking about controls, right? And once we have determined all those key controls and tested all those key controls to see if they're operating effectively or not, then we'll be able to determine what the level of control risk is. And once we finalize our level of control risk, we'll be able to determine how much we need to do in terms of substantive work. Right? So if all the controls appear to be working and control risk is lower, we'll get to do a little less work substantively. And we'll also get to move more work up to interim. Just to remind you guys, substantive procedures are made up of 2 parts. So you have the substantive analytical procedures on the one hand, and then you also have these substantive tests of details on the other hand. So this slide summarizes some different substantive analytical procedures that we would do with respect to this account. So you would have things like looking at receivables turnover, days sales outstanding, things like that. You would compare them over, typically for those types of ratios. You wouldn't just compare this year to last year. You'd look at how they're trending over time, like 5 years or something like that. You would also look at aging categories on the aged AR trial balance, like we talked about last time, and you'd see how they're trending over time. So last year versus this year. So we talked about how you'd look at these categories like 30 days, 60 days, greater than 90 days, and you'd see how they compared prior year to this year. So is your over 90-day category skyrocketing? Then that's probably, a pretty bad sign for your business. You can look at things like bad debt expense as a percentage of revenue. How is that trending over time? AFDA as a percentage of AR. How is that changing over time? Those are, I think, pretty obvious. Like, if it's getting bigger, it's worse. Large customer account balances compared to last period. So something to think about here is if a company has a very large customers that make up a lot of their revenue, they tend to be pretty dependent on them. So if we suddenly see those large customers drop off the face of the earth, right, they're no longer in their AR balance, that would be a pretty concerning sign for us. This slide summarizes different substantive tests of transactions you can do. And we have these things, they're sort of divided up. So we see on this slide substantive tests of transactions, and you see your class of transactions assertions listed here, and it's talking about different tests of sales. Then you see on this slide, a couple slides down, tests of details of account balances, and we see the other half of the assertions listed, right? The balance sheet assertions are listed. The reason why things are split up this way is because when you're talking about the revenues process, you have all these income statement type accounts like sales, cost of sales, and they have these class of transactions assertions associated with them. And typically, those accounts are going to be tested in conjunction with your test of controls. And that's actually what is being said in this little point down here. So generally, if you read through the tests, you'll also get a sense for this. So the test, for example, for occurrence says you would test it by pulling a sample of sales transactions recorded in the sales journal, and then you trace those items back to customer orders and shipping documents. Well, that sounds like a lot of test of controls too. Like, we do that as a test of control to make sure there's a 3-way match, right? We talked about this as a 3-way match between invoice, customer order, shipping document to make sure everything is in order. And this particular control, you can do at any time. You can test it at any time of year. And we talked about this concept too a lot earlier of the dual purpose test. So this is something that would count as a test of control over this particular revenue control, but it also counts as a substantive test of revenue. That's why we see the procedures divided up this way, because we have these accounts like revenue, which we effectively kind of substantively test when we're doing our test of controls. And then we have these other accounts like accounts receivable, which we perform separate substantive tests on because we are not effectively testing them through our test of controls. So these types of accounts like AR, we have to go out of our way to make sure we're testing them as of particular balance sheet dates. They can't just be testing them at any point in time the way I can these other accounts. So most of these things like revenue occurrence, completeness, authorization, I'm testing throughout the year when I do my TOC. And so I actually say down here, probably these assertions for revenue and for the income statement accounts associated with the revenue process, probably those are getting tested early on in July and August when you're doing your test of controls. The one exception to this is when I test cutoff for revenue and sales. So cutoff for revenue will be tested obviously at the end of the year, right? Because the whole point of cutoff is I want to make sure sales are being recorded in the correct period. So obviously that one I'm going to want to test as of period ends. So for cutoff, my test is going to be that I pick several random transactions it's usually 10 days, 2 weeks or so, sometimes 1 week, some period, short period before year end. And then I'm also going to have, 10 days after period ends. And I'm going to pick a few random shipments from that period too. I'm going to test a random sample of both, and I'm going to pull all the documents associated with them, right? Shipping docs, invoices, customer order, and then I can make sure that those sales are recorded in the correct period. And I'm going to consider all these things like, what are the shipping terms, right? Was it FOB shipping point? Was it FOB destination? When did it arrive if it was FOB destination? When was it shipped if it was shipping point? So I'm going to consider all these important things. For the most part, what we're going to be talking through today is actually going to be these tests of details that we do over the account balances. So we'll mostly be talking about the substantive tests that we perform over AR and AFDA, right? Because our revenues test really goes along with all that control stuff that we talked about last time in part one. So we're going to talk through one at a time, basically, tests we would do to get comfortable that all these assertions associated with AR are as they should be. So starting off with existence, okay? So existence is definitely our assertion that we're typically most concerned with for AR. And when I say most concerned with, it kind of has the highest risk of intentional misstatement associated with accounts receivable. As we've talked about that quite a bit at this point. And we want to make sure there's no fictitious customer accounts sitting in AR. And the big procedure we use here, we've been talking about it for weeks now, is accounts receivable confirmations. We actually, at the very end of this, have a whole little module on confirmations. So for now, I'm just going to leave you in suspense for a few minutes. We're going to move on and talk about everything else. And then at the end, we have that little module on confirmations. So we're going to come back to it. So next up is rights and obligations, right? So this is all about making sure that the accounts receivable are actually owned by the entity. This is not usually something we are very concerned with as auditors, but sometimes, and this is typically if a company is in pretty dire financial straits, a company might sell off its accounts receivable. There are, I think, a very few companies that purchase accounts receivable. They will actually buy AR and then they get to collect it. And they obviously buy it at a discounted rate. So they're not going to give you dollar for dollar what's sitting in AR. They might buy it at like 90% of what it's worth or something, depending on their assessment of, how well they think your customers are going to pay and all that good stuff. So generally, if a company is doing that, obviously they're not in the best of positions. They would be very strapped for cash. So it might be a sign of, impending bankruptcy or something like that. Pretty rare. So the question is, how would you test for this, right? How would you test for a company factoring or selling off their AR? Well, the one way you would not test for this is through accounts receivable confirmations. So AR confirmations are a bad test for this because most customers actually won't know or won't be aware of their AR being sold off or factored. So not a good test for R&O. Things that are good tests here are minutes. So specifically reading board of director meeting minutes and stuff like that. The idea there is if a company were going to do something as drastic as selling off its accounts receivable, we most likely would have discussed it in a board meeting. But again, if the company were going out of its way to hide this and conceal this from you, then yeah, they might, alter their minutes or something like that. Inquiry is another one here. So basic inquiry with management. Hey, do you own your AR? This is another procedure. Another thing is cash receipts. So we can look for large or unusual cash receipts. And when I say large or unusual, think about the size of most companies' accounts receivable, right? Versus the size of the average payment they get for sale of product, right? So maybe when I sell off my product, I'm getting something like $50,000 here, $100,000 here. But the size of my AR might be, $4 million. So that's clearly going to be a very unusually large cash receipt hitting the books. So it will stand out. The other thing is the party on the other end will stand out. So as an auditor, when you're looking, so for instance, my companies were all manufacturing. So I've mentioned before, Home Depot was a big client we'd often see. So if you're seeing companies like Home Depot and Lowe's and places like that, those are their normal customers, then you'll kind of get to recognize those as names. So these are the people that are making the big payments that you're used to seeing, right? And then out of nowhere, you see this company known for actually purchasing AR, because I said there are very few companies, right? There's 5 or something. So you see ABC AR purchasers sending them a payment of $5 million. Clear, large, unusual cash receipt happening right there. So that's another very good way to find it. Okay. So completeness, what we want to make sure here is that all AR that should be included in the subledger have been included in the subledger. The big control here is always reconciling the trial balance to the GL. And basically we're trying to detect an omission. And what we're hoping is if something isn't recorded in one place, then it is recorded in another place. And so we'll be able to detect it when we're performing that reconciliation. Now, if the item is not recorded anywhere, then obviously that reconciliation won't really help. So we are kind of counting on it being recorded in one of these places, right, in order for us to find it through a mismatch. And generally, I think I told you guys before about this, but what we're expecting to find is when we would confirm accounts receivable, we would ask for an AR detail. And so we would see something like, okay, on your trial balance, you told us your AR was worth 20 million, but the AR subledger you gave us, so that's the trial balance, but on the AR subledger you gave us, all your little individual customer accounts are only totaling up to 15 million. We're like, where is the missing 5 million? So this is kind of what we're talking about with a completeness test. And then the company can say, oh, that 5 million is our Canadian AR. And because our Canadian operation was an acquisition, they're on this separate GL system, so we just forgot to include it. So it could be something like that. So kind of get the idea. All right, valuation and allocation. So obviously our concern here with valuation, our key concern is typically that AR is overvalued and accounts receivable might be recorded at 100% of its value when in fact it's not actually completely collectible. The main thing here is we want to make sure that allowance for doubtful accounts is adequate. So in order to figure out if allowance for doubtful accounts is adequate, number one, we want to look at things like the entity's policy for granting credit in the first place, which is what this talks about. So is their policy good there? Because that's sort of the first line of defense with the idea of prevention. Right? We want to prevent customers that with bad credit from opening lines of credit with us in the first place. The second is kind of this idea of, okay, now that we have mostly good customers, how good of a job are we doing at actually estimating allowance for doubtful accounts? Like how much of this is uncollectible? For this, we're going to do things like reviewing the aged trial balance. And we'll also do things, another big procedure here is comparing historical write-offs to the amount that sits in allowance for doubtful accounts, right? If historical write-offs are about 3% of AR and allowance for doubtful accounts are about 3% of AR, then we know we're kind of on the right track. And this slide is just illustrating that aged trial balance, doing a much better job than my little sketch earlier. So it is showing, okay, here we have this sort of total AR, and then we have it split out into these categories for less than 30 days, which would be current, 31 to 60 days, which may still be current because a lot of customers will often have 60-day terms. And then 61 to 90 days, which is probably a little bit overdue for most customers. Like a 3-month terms would be extremely rare. And greater than 90 days, which is for sure overdue. And a lot of times you'll see a greater than 180 days in these aged trial balances as well. And then what you'll typically see people do with these is divide each of these categories by the total. So the 2 would be divided by the 3.7 million. So you can see how much is sitting in each category. And then you would compare that to prior year to do some kind of, analytical look at how these categories are moving over time. Okay, classification. So a few classification issues with AR. One is if you have any material credits sitting in AR due to issuance of credit memos and things like that, then you would want to reclassify those to AP. And you'll see this when we do Chapter 11 in AP. It says the same thing. It says if there's material debits in AP, you need to reclassify those to AR. So this also could happen if you have a customer that you also purchase from. You also want to make sure short-term and long-term receivables are appropriately segregated. And we know the rule is generally, if you expect to get paid within the year, it should be a short term. Lastly, making sure receivables are separated into appropriate categories. So trade AR versus other types of receivables, like a loan receivable or something like that.